A lot going on. And I was just looking at some of the headlines from today. Core inflation rising to a 40-year high. Manhattan luxury apartment rents still hitting record highs. China's bursting housing bubble will rock the economy for years. Hong Kong property stocks jump on a potential tax cut report. It's a yin and yang of headlines on a daily basis, on an hourly basis. You guys, nearly $600 billion in your portfolio. Massive. World's largest. How do you see the real estate environment? Let's start macro, big.
So really macro, it is an exciting and interesting time because as you can see, there's different signals coming through, and I think we are better positioned than anyone to know what's really happening. We have $600 billion of real estate. We're in 37 different countries. A portfolio, though, that's highly concentrated into 4 key themes. 80% of our capital is in warehouses, rental housing, lab office, and hospitality investments. And what I'd say we're seeing is actually very strong fundamentals in those sectors. So when you talk about property performance, particularly for rental housing, that continues to be strong, partly because of the pressures on the for-sale market with rising interest rates. Logistics demand, so warehouses. In the U.S. today, we are at record low vacancies, less than 3% vacancies in the markets we operate in, which are the densest, most urban kind of areas. And we're also seeing very strong rent growth. So in the U.S., and last month, rent growth in our markets was 30%. Wow. In Canada, it was even stronger, 50%. And so I think when we're thinking about the real estate market, we continue to see a lot of strength, notwithstanding there are pressures around us in terms of interest rates, an economy that the central governments are, of course, trying to cool, and persistent inflation. But we feel really well positioned for that. And I'd also highlight that I think this moment in real estate, this cycle is quite different than others we've been in the past.
Different good, different bad.
I'd say good, different. I mean, good, different. When you think about what kind of led to real estate downturns in the past, there were really 2 primary factors. It was too much capital, generally in the form of debt, creating greater leverage, fueling new speculative development, and it was too many cranes, too much development. And really, when you think about what happened in the years following the financial crisis and leading up into COVID, we really never saw those excesses come into our market. And so as we head into a period where there may be more economic headwinds, real estate actually is really well positioned from a fundamental standpoint.
Economic headwinds or recession?
It's very hard to call, and I'm not.
Why is it so hard?
I think part of it is what we're seeing, and some of the things that I think the central governments are trying to combat, which is just this continued strength. They see low unemployment, strong rent growth, and that is part of what the big challenge is ahead. So I don't know if we're going to have a recession. I'm not an economist, but I would say there's definitely economic cooling.
Are you guys having conversations internally, like thinking like, hey guys, we need to be thinking that maybe in this market,
Yeah, what I would say is we've been planning for a long time, and this comes through in the portfolio we've constructed for an environment that might have been like this in terms of higher interest rates, higher inflation. And so we really focused on trying to be in those high cash flow growth assets. And again, I'd say today we're still seeing those stronger than inflationary cash flows in our portfolio. But certainly, we are always trying to position for environments that change. We've been doing this for 30 years. We've seen a lot of different environments. We thought we had seen it all, and then COVID hit, and hotel revenues went to zero. I'm telling you, no one underwrote that before we had a pandemic.
Yeah.
But the great news is our portfolios are built really to try to withstand any kind of environment. And the higher than anticipated rent growth we've experienced, again, may kind of come down modestly, but we feel really well positioned for that.
And distress for you guys can be opportunity, big
Definitely.
time. We saw that after the financial crisis in terms of housing.
I would say environments with distress, with volatility, with a pullback in capital markets activity, and we're seeing in particular much more constrained capital markets today, that tends to be a great environment for us and really for any investor who is well capitalized and who has real strengths to lean on. So we have a data advantage. Our portfolio gives us more information on what's really happening. That helps us build conviction around what we want to do next. And then I'd say the combination of deep experience from a large team and capital makes us well positioned to really support situations where Others may be needing to sell assets. Others might need liquidity. And we're able to then get in and buy high quality real estate.
I want to ask you, this week on Bloomberg, Greenwich Economic Forum, Sam Zell commenting, retail is still very much a falling knife, and that the office market will see a lot of downward repricing. And then you had Barry Sternlicht at the Robinhood Investors Conference of Starwood, of course, Capital Investors, says he sees incredible opportunities to find distressed investments in the real estate market. First, retail, falling knife, do you agree?
I think retail has been under pressure for a long time, and that's a big part of why we have not bought a shopping mall in the U.S. In over a decade. Yeah. There are pockets that are showing greater strength, so grocery-anchored shopping centers in dense urban areas. But I'd say overall, it's one of the asset classes more under pressure. And in our business, we played the counterpoint of that, which was warehouse investing. So retail, brick and mortar. The movement of goods online is really what started that challenge. It was against a backdrop of oversupply in a lot of places. And so but there's always kind of other opportunities. And for us, it was, okay, how do we invest in the warehouses that are benefiting from the retail activity moving to a different format? But I'd say, yeah, continuing to see pressure in an area where we are more cautious.
But like India, retail's a different story. Because you guys are global.
We
have to
global.
Remember that. Yeah.
And I'd say there's overall been great consistency in the themes where we invest in globally. I think a market like India is a differentiated story, though. So in India, we're now one of the largest owners of shopping malls in the country. But there are, I'd say overall, relative to a population that has 1.4 billion people, there are very few of them. And so it's a very different story. It's a country where the growing middle class, greater consumption, people looking more toward organized retail as a place. They want to go not only to shop, but eat out and have experiences. And again, not so dissimilar to what are the formats of retail that are going to thrive anywhere in the world. It's something offering more than just a place to go buy something. It's got to offer that kind of experience, community, and a whole variety of things that will attract people to those stores. So our investment in India has been very successful. We made it, I think, at a great time also where there was a lot of change happening in the retail sector. More international retailers were able to access that market, and that really led to a lot of strong leasing velocity for the assets we were in. So a little bit different. And that's one of the great things that's so fun about our business is we have teams all over the globe. And while certainly there are asset classes like retail where we have a more cautious posture, we have the opportunity to dig in and understand what's happening, regardless of whether we know at the time it's going to be kind of an area to really dig into and do more. Right. That was an example where the team kept at it, kept thinking about standing the problem and the challenge and the opportunity on its head and said, this is a very different market. And I feel really proud that we have an investment committee that keeps an open mind to that and says, we kind of look we know where we kind of want to go, but where the other opportunities present themselves and we can invest in scale, we're going to activate that. All
right, so let me follow up on office market that Sam Zell said a lot of downward pricing to come. Do you agree? I mean, this is, I think, one of the grand big questions of our time. Yeah. Coming off of the pandemic, there's this constant flow of news stories about people not coming back to the offices, working from home, old office space people don't want. What's the reality from your perspective? And
I'd say we see a lot of what you're describing, which is that, and by the way, I would take a step back and say, if you go back pre-pandemic, I think a lot of the questions, the experimentation you're seeing with formats was starting to happen then. And so if we were together in 2017, 2018, I might have asked you, in your office buildings, do you sometimes feel like the lobby looks more like a hotel now, right? I see you're all chuckling, right? Everyone was kind of moving toward having more amenities, having better conference space, co-locating different types of tenants who could be symbiotic with one another. And I think even then, we saw tenants doing what they're doing now, which is saying, I'm not just looking for 4 walls to put my people in. Right. I am looking to create an experience. And we see that kind of thinking just much more pronounced today. Business leaders are saying, we do want our people back. I have yet to meet a CEO who is happy with everybody kind of staying in place on their couches, particularly now that there's more distractions than there were in May 2020. People want to be back. They want to propel their business. They want to propel creative processes. At our firm, we are really very much an apprenticeship culture. We need to train people. I need to be trained. I'm getting that all the time too. And so what we see happening is those businesses are saying, what are the spaces that are going to attract people back and compete well with homes. And so the buildings that are newer, they have better amenities, they have better sustainability features, I would say also, those are attracting the best tenants. And then on the capital market side, you see that reflected as well.
Right.
Better debt costs for those kinds of buildings, better
So was
bidding.
WeWork the idea actually makes sense in today's environment?
I would say WeWork as a offering for a tenant was a great idea and remains a great idea. And you see this replicated, imitation is a form of flattery, by so many office landlords and different office companies offering a version of that. Essentially, the way I think about it is for decades, maybe eons, offices offered their customers, their tenants, one thing, which was a long-term lease in space that the tenant was responsible for fitting out themselves. What WeWork said was, we know you don't really know how to build out the space, but you want a place that feels good to come to. We also know you don't know exactly what you need 10 years from now, maybe even 5 years from now.
Right.
And so we're going to offer you a more flexible product that's really a customer service oriented business. And that's a good model, right? And so that, I think that concept is what we're seeing today. I'd say also what we're seeing in to your point, in the buildings that are winning in terms of both tenant demand and then capital markets activity, it's some of the similar things we saw a lot of tech companies gravitating to 10, 15 years ago. They had a population that was very mobile, that wanted flexibility. They wanted their places to be great places for those people to come to work. And you see a lot of those kinds of features showing up in the buildings that are the best ones today. We certainly, while we have caution on those older assets, and New York City is full of them.
Caution, or do you think at some point, their time has passed?
Well, it's a good question. In New York City, for example, it's a very old office stock market. The average building in New York is 67 years old. Only about, I think, something like 7% of the office stock is under 10 years old. So some of those buildings will have to live through a certain kind of transition. But in our, if you look at our activity over the past year or so here in New York, we bought into One Manhattan West, brand new, well amenitized, great location building. In Dublin, we did something similar, very similar recently. Best in class building, best sustainability standards, highly occupied tech tenants in a really dynamic part of the market. And so we will lean into those kinds of opportunities. But you're right, I think some of the buildings that are more challenged from the combination of age and features, maybe location as well, they're having a tougher time in this environment.
I want to ask all of you, first of all, who's got kind of flexible working, home and in the office? Okay, and who's just in the office?
2 hands up.
Who's just home? Okay, good feel. So a lot of flexibility. All right, I have another question for everybody. Our poll for our audience, and I think maybe some people have already been answering it. What area of commercial real estate is most attractive? And we put out hospitality, office, residential, retail, warehousing, all sectors that you guys, there are some of your major themes, and I think some of you have already...
Warehousing is winning.
Warehousing. All right, so what would you say is most attractive?
I think you're all smart investors.
Seriously? Warehousing?
We have been, warehousing has been our most significant investment theme really since the global financial crisis. Roughly 40% of our portfolio today is in warehouses globally. We have 1.1 billion square feet.
What are the returns on something like that?
So we invest in it across our strategies. So we have opportunistic, higher returns in vehicles that invest, drive cash flow performance over a short period of time, invest, and then return capital. And then we also invested in more stable strategies. We're trying to hold these for the long term. I'd say the tie that binds is the kinds of assets we're looking for and which markets. Our primary focus is really on what are known as last mile. They're not all technically in the last mile, might be last 20 kilometers, but think about those warehouses that can get you goods in the same day that are located close to dense population centers. So warehouse as a sector has done well, has been an outperformer overall, but we're always trying to be in the locations and the assets that have the best performance within a well-performing sector. And so that's been our focus. As I mentioned, we continue to see record levels of rent growth and record demand. It does help that we're in assets where we are attractive to so many different kinds of tenants who are doing a combination of things. The demand's definitely propelled by e-commerce. And we see e-commerce penetration rates continuing to climb higher.
Is there going to be even more that I think about as there's more companies we talk about coming to manufacture back in their kind of domestic homelands, that they're going to need these kind of facilities?
Absolutely. And we're seeing that happening, that the reshoring or just realignment of supply chains. even within a country, to be closer in to where those goods and the services ultimately need to be provided. I'd also say in a tougher economy where we're starting to see inventories build for retailers, those inventories go somewhere. It goes to a warehouse.
I want to ask you, we've got a great question from the audience. I'll bring it up in a second, but you sound very optimistic. Are you? What's a word? Like, I think about residential or even office. I think residential, we're like, is it a bubble bursting? Is it, hot? Like, what's a word to describe something like residential right now?
So residential, I'd say, is bifurcated. I think if you are in the business of selling homes, it's a more challenging market. And that is because the cost of owning has gone up dramatically in the last year. So we think in this country about 54% higher to own today than it was a year ago. Yesterday I was in Las Vegas. What we're seeing is wide dispersion in the cost to rent versus the cost to own, with ownership being more expensive. In Las Vegas, it's 2 times more expensive to own a home on a monthly cost basis than it is to rent. But that is propelling the performance of rental apartments. So when you say you seem optimistic, it all depends on, I think, what you own and the sectors where you want to be more active. And again, we have a portfolio, and I see a fun question coming up now. You decide whether you want to take it, about our portfolio today versus dark days of COVID. I would say
the question is, how does your portfolio compare between the darkest days of COVID and now?
I would say in our portfolio, there's actually a lot of consistency, but that's because we went into COVID with a great portfolio from our perspective and from the perspective of which sectors do you want to be in to generate great performance. So when I think about Blackstone real estate over time, when the financial crisis hit, 50% of our portfolio roughly was in office, 50% in hospitality. And when we got to COVID instead, only 7% was in hospitality. And I think something in that sort of neighborhood was office, and a big portion of that was lab office and also studio and media content office, which is a great performer. So again, there's been a lot of consistency, and part of that is COVID, and what happened during COVID really accelerated trends we were already investing behind, and so we really just took opportunities to do more of those.
How did you know that those, tell me, is there a metric out there? There's so much stuff coming at us right now. What are the metrics you follow to say, okay, this is where we have to start buying, investing now, because that's what's going to be big 5 years from now, 7 years, 10 years, whatever?
Well, our process, and it might sound funny for a real estate investor to say this, but our process really starts with what's happening in the world away from real estate. So what is happening in how people are living, working, spending their leisure time, and which are the assets that are going to benefit from that? So you think about the explosion of demand for content, and that was starting pre-COVID, but COVID certainly has accelerated that. Or you think about the unprecedented data creation and consumption. We've created more data in the last 3 years than in the rest of human history combined. You're seeing that in demand for data centers. So what's happening in the world helps us identify, well, where are the sectors we want to be? And so a good example is we took private a company called QTS. It's a $10 billion company. We in real estate did it in partnership with our infrastructure business. And our scale was a huge benefit there, right? Because we could buy a great company with a great management team with the opportunity to continue to grow with their tenants. And we saw things, again, not that we thought data was peaking and demand was peaking, which maybe others would have thought, given kind of the trajectory that business had been on. We said, actually, we think we might just be at the beginning, because just think again about what businesses are doing, what people are doing. Right. And what we've seen in our first year of ownership is actually more leasing activity than the company's entire 15-year history combined cumulatively. So we certainly, of course, have to always look at supply trends. Supply, is one of the things that works the hardest against you in real estate space. We care deeply about what is our basis and assets. But I think as far as developing themes, figuring out where to go, we try to think of where are the places we're going to have the greatest tailwinds.
All right. Having said that, so we've all read about a new Blackstone flagship global real estate fund, $30 billion, and that you've raised around $25 billion in just 3 months. The remaining is expected to, I think it's already fully allocated, expected to be the largest PE vehicle and drawdown in fund in history, about 50% larger than your predecessor fund of $20 billion, which at that point, back in 2019, was the largest ever real estate fund at the time. Massive. Why now? How quickly do you expect to put that to work?
Well, I would say
Is that a sign of that there's lots of opportunity?
So I'd say a couple things. One is I'm limited in what I can say about fundraising. But two is I think it's a sign of two things. One is confidence from our investors because we have been doing this and delivering great returns for a very long period of time. Investors are leaning into their best managers who they think have the most differentiated opportunity set. And yes, I think they and all of us say, we don't exactly know what the opportunities are going to be or how they're going to materialize. But we know Blackstone, with its scale, with its team, with its experience, and with this thematic approach, is really well positioned in any environment, and particularly now where there's a lot of dislocation and volatility.